Most traders start with EUR US GBP USD and stay there. That is understandable. But sticking only to dollar pairs means you are working with a narrow slice of the Forex market. Minor currency pairs give you access to the rest of it. Minor pairs, also called cross pairs or crosses, are currency pairs that do not include the US dollar. Instead, they pair two of the other major world currencies against each other. Think EUR GBP, GPJP, or AUD CAD. These pairs are actively traded. They move on real economic forces, and they behave quite differently from the dollar-based pairs most beginners start with. The most widely traded crosses tend to involve the euro, the British pound, or the Japanese yen. EUR JPY is known for relatively wide price swings. GBP JPY is one of the more volatile pairs in the entire Forex market. Large daily ranges, fast moves, and sharp reactions to news. EUR GBP, by contrast, tends to trade in a tighter range, which can suit traders who prefer more measured price action. Each pair has its own character, and learning that character takes time. The biggest practical difference between minor and major pairs is liquidity. The US dollar is involved in the vast majority of global Forex transactions, so major pairs attract more buyers and sellers at any given moment. Minor pairs trade at lower volumes. That means wider spreads, the difference between the buy and sell price, which is a direct cost to you as a trader. A trade that looks attractive on EUR USD might offer a much less favorable picture when you apply the same setup to a cross with a wider spread. Always factor that cost in before entering a position. Volatility also works differently in crosses. Some minor pairs become extremely active when two trading sessions overlap. GBP-JP, for example, can move sharply during the London session. Knowing when your pair is most liquid and most active matters for execution quality and for sizing your risk appropriately. What drives cross pairs? The same things that drive majors: central bank decisions, economic data, political events. But without the dollar in the mix, you need to follow the fundamentals of both countries in the pair. Commodity prices also influence certain crosses. The Australian and Canadian dollars are tied closely to raw material exports, so pairs like JPY or CAD-JPY can react to shifts in oil or metals markets. Trading involves real risk. Wider spreads and lower liquidity in minor pairs can amplify that risk, so only ever trade with money you can afford to lose. The practical takeaway: before adding any new cross pair to your trading, check the typical spread your broker charges on that instrument and factor it into your risk-to-reward calculation before you place a single trade.